All right.
Good morning, everybody.
Good morning.
Welcome to another edition of Cup of Joe with Jake and Josh. This week, over the next few weeks, we're going to be talking about interest rates. Because truthfully, especially in the mortgage process, interest rates can be one of the most confusing things about the process.
Honestly.
Yeah, and in the last couple of years of the refi boom, in 2020 and 2021, that kind of became a bit of a boasting point between everybody. It's like, hey, I got a 2.875. What'd you get? Well, I got a 2.125. And everybody's like, well, how'd that happen? So today we're really going to dissect, some of the criteria. There's actually quite a bit of criteria that go into why you end up with the interest rate that you end up with. Over these next few shows, we're really going to just tackle a lot of the bigger ones, just so you have a better understanding as you get into this process of why you ended up with, say, a 4% interest rate and your neighbor ended up with a 4.25 interest rate. And it may be that everything else on paper looks the same. But, when you get into this criteria, this is how we're going to walk through it so you have a better understanding. So, Jake, why don't you take us through the first criteria?
Yeah, let's do that. So for the first criteria is actually the criteria of loan amount. So from anywhere from about $180,000 till you get to about $647,000, you're looking at kind of what's known as our main loan limit. And this is going to be what the loan limit is for, at least in California, for conventional, which is your Fannie and Freddie, your FHA, your VA, and your USDA, which are all actually government loans. Now, once you get above the loan limit of about 647, you're looking into what's known as jumbo loans, and this is a completely different interest rate sector. So the loan amount does a lot for what you're using, because the higher the risk of the loan, the higher the loan amount, the more risk the bank has. So this will actually raise and lower your rate depending on kind of where you're at on loan amount.
Absolutely. And then one of the second criteria is the loan type. So much like Jake referenced earlier, your conventional, your Fannie and Freddie, as well as some of your government loans, FHA, VA, USDA, or even adjustable rate mortgages, reverse mortgages, all of those loan types may carry a different interest rate. And depending on really what you're trying to accomplish, it might make more sense for you to go with a certain type of loan. One of the examples I always bring up is, while VA is a fantastic loan and I love it and we love working with our veterans, in some markets, sometimes even in this market, it may make more sense to go with a conventional loan. And one of the reasons being in that is some sellers will actually list their home and they'll say, only bring conventional, do not bring government loans like FHA or VA. And the reason behind that is the FHA or VA loan may require a little bit more stricter appraisals, and they might catch a little bit more in that inspection and appraisal, and then require the seller to repair that or fix it before the loan will go through. And if they don't do that, then the loan will not go through. Yeah. Whereas conventional has a little bit more of relaxed viewpoint on those things, and so therefore you'll likely get a conventional loan accepted over a VA in some markets. Now, again, even in that, there's great ways in this market for VA and FHA to get accepted. We've actually got 3 going ourselves right now that are in contract and are accepted. So with the right strategy, you can do that. It's just a matter of really sitting down with you as the client, with us as the lender, and really walking through what are your goals? What are you wanting to accomplish? How long are you going to stay in this home? What would you like to do with this home? What kind of home are you looking for? Some people are like, hey, I want a fixer-upper. And so all of these questions lead to us as your advisor, as your lender, to really walk you through, hey, this is probably the best loan type for you for what you're looking to accomplish. And again, with the loan type, that's going to affect the type of interest rate you get.
And so for a long time, especially in this market, I know a lot of times the government loans, so FHA, VA, and USDA were actually a lot lower of an interest rate for a little while these last couple months, and now they're actually higher than a conventional.
At times,
depending on the loan. But it's interesting when you think about it, whether it's inspections or other things that are included in the loan, really looking at not only interest rate, but everything that's going into the loan loan altogether. I know for someone, you know, a lot of times it's kind of known and people talk about the fact that FHA has a lower interest rate a lot of times for first-time buyers. But recently I was looking at quotes yesterday for someone, and it was actually cheaper for them to go to conventional. So interesting when you see, you know, the market change the type of loan you have versus how volatile the market is at this time. It does really change your loans as well. So the last criteria for today is actually going to be term. So the actual length of time that you're in your loan for. So now, naturally, kind of the way it works is if you're borrowing an amount of money and you have interest on it, obviously your interest rate, the shorter amount of time you have that loan, or the shorter amount of time you're making those payments, your payment is going to be higher, but a lot of times the total amount you're paying with interest rate is actually going to be lower. So this goes the same usually for interest rates. So if you get a 10 or a 15-year term, you're going to have a lower interest rate than if you're getting a 25 or a 30-year term. Now they do this because, again, it measures risk. If you can pay more monthly towards the principal itself, then they're going to lower the interest rate a little bit, so you have less payment on top of that to make overall.
Even though your monthly payment will likely be much higher than if you were to go for a 30-year interest rate. And so again, that goes back to that discussion of, you know, what are you looking to do? If you're looking for the lowest overall payment monthly, then you're going to want to go with a longer term, and that also affect the type of loan you get. But if you're like, hey, I'd like to pay less over the term of the loan, then it makes more sense to go shorter. But these are all the options that your lender should be discussing with you, walking you through to make sure you have the right understanding so you can achieve your goals as quickly as humanly possible and as efficiently as humanly possible.
Absolutely. Well, that pretty much closes it out for today. Thanks for tuning in. We will have more on interest rates in the next few weeks coming out for you as well. But for now, that's it. Please feel free to like, comment, and subscribe. Share this video if you found it helpful, and we'll see you in a few weeks for Cup of Joe with Jake and Josh.
Thanks for joining us, y'all. Perfect.
Cool.
I like it. That was good.